What's up, guys? So in this video we're going to be going over the 5 different pieces of criteria I look for in the stocks that I trade, specifically going over different options that I trade, however looking at also the stocks themselves. So this is different criteria that I look for my A+ setups and showing you exactly why and where I take those trades. So let's go ahead, dive right into it. So the first one, when it comes to pieces of criteria that I look for, is going to be liquid options. Okay, now when I trade options, it's very important that the options I'm trading are very liquid, because if they're not, I'm going to end up being down as soon as I get in on the option because of the spread. So let me show you Tastyworks here. Now Tastyworks is a broker that shows options in a very good way. I don't use it for my trading, but it is a very good broker. So right now the market's closed, so it's not going to show volume except for SPX, because SPX options trade while the market is closed. But if we look at an option like SPY, for example, SPY is a very, very liquid ETF, and you can use it to trade options very well. You can see just by looking at, a day out or something, the spreads are, 3 cents, right? Which is very, very good in trading options. Now, there's no specific spread percentage that I would consider quote unquote good. It really just comes down to experience and what you feel comfortable with in your trading, right? Now, SPY obviously is going to be very liquid. Stocks like Apple are going to be very liquid as well. Stocks like Tesla. The big name stocks are typically going to be very liquid. Those are kind of the ones that you want to look for in your trading, right? Now, I can show you a stock like CMG, right? And this one, if we look, 11 days out, the spreads are huge. There's no volume on it, right? It's not even showing the bid and the ask on some of these names. So it's very, very illiquid, right? Something like SPX. SPX is very, very liquid, right? You can go a day out, you can see how much volume is being traded, right? 0 days out, we have over 1,000 contracts on the 4080 calls, and the spreads are only 10 cents for a stock that's at, or an industry that's at 4,000, right? So overall, it's a very, very liquid name. And so stocks like SPX, Tesla, Apple, the ones that have high volume and liquid options, are the ones that you're going to want to trading. Now, let's go ahead and move on to the second one. So the second piece of criteria is going to be a big range. Okay, big range stocks are very, very important. Okay, what I mean by that, the big range, that you don't want to be trading stocks that have an extremely small range, right? To keep it quite simple, we can look at a stock like Guild, right? GILD. This is on the weekly chart, keep in mind. If I go back to 2019, you can see this area of price action here, right? This range here is very, very small. For about a year, we stayed in between $61 and $67, right? When you see that type of trade happening, that type of action happening in the stock, it's a good idea that this is something you don't necessarily want to trade. Now, recently, we did have a pretty big move. It's been a little bit more active. But typically, when you see this type of action like this, it's typically a good sign to stay away and trade something else, right? We can look at a stock like Google. It's a little bit better, right? You can see here we have a lot more up and down, a lot more, movement in it. So it's way less choppy than Guild, right? And especially looking at different time frames. But having stocks that move in a very big range allows you to take advantage of bigger moves, and you're not going to be subject to a lot of decay from the options that you're getting on all of these stocks. So first one, obviously going to be liquid options. Second one being a big range, making sure that's very important that you have in your trading. Now, the third one, typically more for small accounts, doesn't apply to me as much, but I still prefer this. Third one is going to be high priced options, okay? High priced options, okay? Now, why high priced options, right? Let me show you an example, right? We can look at a stock like BAC. BAC is pretty cheap options. If we're looking at day out, week out, right? Almost all of these are under $1 if we're looking at the money, right? When you have options like these that are at the dollar or under $1 at the money, right? For example, this option right here, right? It's about a few strikes out of the money, 33 put. We have, a 1 to 2 cent spread. Now the spreads on this are pretty good, right? 1 to 2 cents is still good. But on an option that's $20, right? It's still a pretty big margin, right? There's still a pretty big spread in that sense, which means you're still going to be taking on bigger, you still need a bigger move to occur while that trade is occurring if you want to see better results, right? Now, with BAC, the other thing is that if you're going to be taking a lot of contracts, right, if you have a larger account, it's just going to end up costing you a lot more contracts, which is going to make sure that you're spending a lot more on commissions, right, which is not something that anyone wants to do, right? So typically I find that trading higher priced options tend to be a lot better, even though they can be a little less liquid. If you find ones that are very liquid and have a good name, especially like SPY, SPX, the ones we were talking about, you're not going to find any trouble with having to pay a lot in commissions, okay? So that's very, very key that I look for in my trading as well. Now, we can zoom out a little bit. Go to number 4. Now, this one is a little bit the opposite of this one, but I'm going to explain. And so this one is going to be 2 contracts. What I mean by that is if you have a small account, right? Get rid of this here. If you have a small account, okay, and you can only afford 1 contract of a stock, you necessarily don't want to be trading that stock, right? So, for example, if we're looking at something like, let's go ahead and look at Tesla, right? Tesla is a pretty big stock, right? So if we go ahead and look at the Tesla options. Now, let's say, for example, we wanted to get into a swing trade. Let's say we were looking for a pullback down to this demand. Let's just say we were looking to get in right now, right? Price is at this 197 area. Let's say we're looking for like a 2-week swing trade, right? So we wanted to get an option contract that's 3 weeks out, right? So if we want to get something, 3 weeks out, somewhat in the money, this one's going to end up costing us $1,000, right? Just for 1 contract. Now, if you're trading on a small account, if you have a $1,000 to $2,000 account, even a $5,000 account, you can only afford really 1 contract within your risk tolerance. That's not going to allow you to scale. So I prefer, especially if it's a small account, that it's best to get a option where you can afford multiple contracts. That way you can scale out at different targets, right? Let's say Tesla here ends up moving up and to 212 at my first target, or let's say 218, I can get out of 1 contract and then hold a runner for the next target up at 237, okay? Doing this allows you to take advantage of that scaling so you're not tied down to 1 contract, okay? So that's very, very important when it comes to your trading. Now, having 2 contracts is key. Now, one more thing I want to put an emphasis on here is that you shouldn't be compensating the options you're taking based on the account size, right? Again, let's say I have a $2,000 account and I'm looking at Tesla and I really want to trade the swing trade. Let's say, I'm hoping for a 2-week swing, so I'm expecting price to hit my target in 2 weeks. So I want to give myself a little bit more time. So I decided to get 3 to 4 weeks out on the option. And I want to get in the money so decay is not going to hurt me, right? So if I'm getting, again, let's say we get 4 weeks out and I want to get in the money, these contracts are at $1,300. And with a 2K account, you may only want to be risking $100 a trade. Now, if let's say I'm getting in here, right, and I want to put my stop below, this low right here, I can tell you that when this option comes back down to this low, this $1,300 option is going to be a lot less than $1,000, okay? So you're going to be down about $300 on this trade, at least. Now, if you have a 2K account, you don't necessarily want to be risking, more than $300 per trade. You want to risk no more than 5% of your account, okay? So with that being said, you shouldn't be trading Tesla in general, right? If you love this trade, but you can't afford this option, a lot of people will tend to say, okay, I'm just going to get way out the money. These ones I can afford. And if I get 3 of these contracts, then I can keep my risk small and still have a good risk reward, right? Does not matter. If you're trading, if you have to compensate by getting way out of the money options, that's not something you want to do. That's going to not get you good results, and it's going to put in bad habits for the rest of your trading. All right, so what you should simply do is not trade that stock and only trade stocks that work within your risk criteria for the options that you prefer to take, right? Which in this case would be something more in the money with a lot more time. Instead of saying, I'm just going to risk it for the biscuit, go 2 weeks out, way out the money. Now I can afford it, but you're taking a lot more disadvantages by doing this, okay? And so that's not something you want to do, okay? Now, we got over 4, so liquid options, big range, high-priced options, 2 contracts at least. The last one that I look for in my setup is very, very simple. It's going to be my setup, okay? I'm not just going to sit here and trade every single stock that I look at, right? It's very important that I'm only trading my high quality setups, which for me is supply, demand, and balance theory, okay? Now, I have a different list of stocks that I trade, different strategies that I use, and if I don't see that the stocks I'm trading are within my setup, I'm simply not going to take the trade, okay? So it's very important that when I'm looking at all of this, everything needs to be in alignment, right? All of this needs to be in alignment for me to want to take the trade, right? So it's very important that I'm looking at not only the stocks themselves, but also the options I'm getting, the amount of contracts I'm getting. All of that plays a factor into the stocks that I'm trading, okay? Now, if you guys do want to see my exact strategies that I use for my trading, go ahead and click that first link in the description. I do have a private mentorship group where I offer one-on-one training, and you can learn exact setups that I use in my strategy, so you can become consistently profitable in 8 weeks without relying on alerts and without trading more than an hour a day. So with that being said, go ahead and click that first link in the description. If you guys did enjoy this video, let me know in the comments below other videos I should make. Leave a like as well, subscribe, and I'll see you all in the next video.